Yo, this is chapter two, time frame alignment. Uh, this is not to be confused with time frame selection. Time frame selection is choosing a chart interval. So if you look at the chart, uh, time frame selection is choosing a day or the daily chart where each candle is a day's worth of information. So, for example, this candle is the current day and it's unfolding live. Or maybe we select 30 minutes where this candle is this past 30 minutes and each candle is 30 minutes. That's time frame selection, choosing the time frame or the uh, chart interval that you want to look at. So let's go back to monthly time frame, which is the higher time frame. We went over that before. When we do a top-down analysis, we start with the higher time frame. So in this case, we're just going to start with the monthly time frame. Uh, Time frame alignment is uh, using the different time frames strategically to position yourself uh, in a good spot. So whether you're betting that the price is going to go up or down, you always want to have a good perspective. So if we look at the chart right now, we can see that price is going up consistently. So we would call that in some cases an uptrend. But if we look at different sections, we can see that price move differently at different times. For example, we see there's a downtrend, there's an uptrend, there's a bit of a range, and then we have the recent spike right now. We'll go over more about profiling the market and setting up your ideas as we go through the mentorship. But right now, we just want to discuss how to use the proper time frames correctly. Uh, but more importantly, we want to discuss how to combine the different time frames. How can we use the weekly time frame along with the daily time frame to get a better picture of what's actually happening in the market? So if we go full screen on the chart, for example, we can look at the same chart or the same asset. So if I'm in Trading View, I can open up this right here and I can make a watch list with certain coins and stuff. So if I choose Bitcoin and I have Bitcoin as well open up, I can see two different time frames, but for the same coin. So right here, let's say I want to look at the monthly time frame, and I can see the monthly candles. And then let's say here on this side, on the right side, I want to look at um, the daily time frame. So we look at daily candles. So we can see from a monthly perspective, the past couple of months have been a bit of a shot upwards. Now, if we look at the daily candle, we can see that through the last month or so, uh, it's been a bit of a range. So let's say this section right here is today all the way back to December 1st. This section right here is the same amount of time. So let me change the color so you can see that. So we have blue and we have blue. So you can see that this is from December 1st to now. And same here, this is December 1st to now. So you can see if you align the time frames correctly, it's pretty powerful, and you're able to get a better picture of what's going on in the grand scheme of things. So you can see from the top down. So this is the left chart is the higher time frame, the HTF, and the right side would be the lower time frame, which is the daily chart. And you can see how they work together. That's the difference between time frame selection, which is just selecting uh, the actual interval, and then time frame alignment, which is aligning the two. So in this case, we're aligning the monthly chart with the daily chart and looking at things that way. Excuse me. Okay, so I want to go over how to use time frame alignment. Uh, we definitely want to spend some time looking at the chart and going through um, how you want to arrange things. It's see what's happening with the price or with the with Bitcoin, for example, if that's what we're looking at. So we use time frame alignment um, to synchronize uh, the different time frames, uh, or to synchronize which time frames we're choosing to use. So depending on how long you intend to hold the trade or what type of trade you're making, there's different ways to organize the time frames or different time frames to choose, I should say. For example, like pairing the weekly with the daily or the monthly with the daily or the weekly with the 4 hour. There's a few different ways to pair things, and we'll go over that in detail in this chapter. But first, we want to just take a look at a high level. Uh, uh, we want to go over how to use or how to begin using time frame alignment. So we'll start with looking at the range that we saw earlier. We have December 1st on the left to the end of this month marked. And then on the chart on the right, we have the same thing, December 1st to the end of the month, or the current where we're at right now. You can see that you get a bit more information on the daily chart, which is what we have on the right. On the chart on the left, from a monthly perspective, you can see that we have a different kind of structure. So we can see that overall, looking at it since April, we've made quite a bit of gains. Um, Whereas on the right, if we're looking from a daily perspective, we only see as far back as January. So the chart on the right would be useful if we were trying to look at things that might help us in the near term. But we don't want to forget about what's happening on the higher time frame, because this will make sure that we stay oriented correctly. Um, let's get rid of what we have marked here. Let's start off first by looking at candle range or candle ranges. So in this case, we're on the monthly chart on the left, and we're on the daily chart on the right. And we can already see I marked this line on the left side, so it came up on the right side because I have the same asset. Have Bitcoin and Bitcoin, just two different windows, and you can do that by selecting this button in Trading View. There should be a layout setup. Even if you're using the app, you should have a button that lets you choose what arrangement. So in this case, we're just looking at two, but it's two of the same. So if we're looking at the candle range, we can see that we have the candle range high, and then we have the candle range low. And then the same range is now marked here, but on the daily chart. So we can see they have a similar structure, but the daily chart provides us with more information. If we want to look back the past couple of weeks, we can see how price behaved. Whereas if we're only looking at the monthly chart, we kind of see things uh, from a wider view. We know that price is in an uptrend, but with the daily chart, we can see that there might have been a couple of moments where price retraced downward in the past couple of weeks. We use the higher time frame to sort what candle range we're going to use, as well as specific key levels. So in this case, the key levels are the candle range high and the candle range low from the monthly. And we're looking at the daily chart, and we can see that from a monthly perspective, price looks like it's pretty high, relatively speaking. So maybe we could take advantage of that somehow. Of course, later on in the mentorship, we'll discuss how to set up trades and take advantage of this. But for now, we're just talking about pairing time frames together. So before we go into further detail about how to use time frame alignment, or before we demonstrate using time frame alignment, I just want to spend some more time discussing the different time frames that we'll be working with. We've covered the HTF, or higher time frame, a bit before, but there's also ITF and LTF. So you have higher time frame. You also have intermediate time frame, and we have lower time frame. So the image on the left shows exactly what we mean by time frame alignment. So we look at the higher time frame key levels and candles to form ranges, and then we keep an eye on the structure that's formed in the intermediate time frame. So that way we can build a profile on the lower time frame, and hopefully find good entries. I just want to reiterate that we use the different time frames, but we start with the higher time frame when doing top-down analysis. All right, so I'm going to show you the best method for aligning time frames. So let's say we decide we're going to work with the monthly time frame as the higher time frame. That would determine what we use for the intermediate time frame and the lower time frame. We'll go over that a little bit further uh, later, but for now, we're just going to start with the monthly time frame as the higher time frame. Um, just note that just remember that there's uh, a technique for or there's a technique behind uh, uh, pairing the time frames. Certain time frames go together. So in this case, we're just choosing the monthly as our higher time frame. So the daily time frame would be the intermediate time frame, and the lower time frame would be the 4 hour time frame. So we're going to start with the monthly time frame. We mark off this candle range. We see the candle range high. So you can type candle range high, but I normally just type CRH for candle range high. And then we have the candle range low. So I'm going to mark the candle range low. Excuse me. But we have the CRH and the CRL, candle range high and candle range low for the month. And this gives us a starting point. So we're also going to take the Fibonacci retracement tool, and we're going to mark the middle point. So that tool's right here, Fibonacci retracement. You should take some time to play around with these tools just to see how they work. But the one I'm using right now at the moment is the Fibonacci retracement. You just pick 2 points. So I'll do that one more time. So Fibonacci retracement, and let's say we pick the top and we pick the bottom. I do have to kind of slide it over a bit just so that I can keep the top and the bottom. And then I just move this a little to the left back to the top. So it's the same distance, right? Up and down. I just slid it to the left. But I'm using the magnet tool, so it's a little trick I do. But the idea is, you just go from top to bottom, and then it gives you the middle point. But if I slide it a little bit to the right, we can see what we're working with now. And that's the higher time frame. That's how we mark our key levels, and that's how we identify a candle range. So once you've identified the HTF key levels or the higher time frame key levels, or in this case, maybe uh, we have a candle range to work with, uh, we then want to move to the next step and try to determine the structure so that we can gain conviction. Uh, just want to make sure the bets we're making are favorable. So the goal would be to find an edge that plays out over time. So we do that with this framework. It helps us build a market profile. So after we mark the key levels on the higher time frame, we move to the intermediate time frame. In this case, our higher time frame is the monthly. That's what we chose. So uh, that would make the intermediate time frame the daily chart. So let's move to the daily chart. Okay, so if we zoom out a bit and we give ourselves a better picture, we can see we're trading outside the range of it. But before we make any decisions, we still want to determine the structure. We will go through market profiling in the mentorship, but that is a topic for another day. So right now, we just want to kind of look at how the uh, uh, chart looks, or sorry, we want to kind of look at the way price uh, has formed uh, a sort of profile. So we see that we were in a strong uptrend, or that we are in an uptrend at the moment, or price is bullish because um, we broke we're breaking highs. So you see here we have a low, a high and a low. The high is broken, and then we have a low, which is a higher low. So here's this low right here. Let's mark that down. So we have a low, we have a higher low, and then we have, let's change the color. We have a high, and we have a higher high. So you see how that works. And then from there, once we broke uh, uh, through, and we had an explosive move upwards, price started to build uh, uh, new levels. So right now we're trading at premium prices, meaning we're trading in the upper part of the range, actually a bit outside of the range at the moment. So for now, let's say we want to build a profile to get an idea of where we're at. So let's say we have this swing up, right? And then we have this range here. Uh, we have this range. Let's say we change the color a bit. Okay, so we have this expansion upwards, and then we have this range. And right now, we're not quite sure what we have going on. So let's say we have some price action that's kind of been trading a bit outside the range. Then we went back into the range. We had a fake out upwards, but then we stayed inside the range. And then price traded again outside the range before we came back down. We did create a new low. We created a new low here. There's a new low that we made. And then we had an expansion, or we're currently expanding upwards, although we are trading outside of the range. And then you can take what you want from that. Some people would say maybe we're bullish, and others would say maybe we're bearish. But for the purpose of what we're doing right now, we're just learning how to read the tape or read price action. But now we've built a bit of structure. We start to see a profile forming, and there are more specific techniques to build a market profile, which we'll go over in another chapter. But as you're looking at price, I just want you to kind of see um, what to look for, or I want to show you what to look for. Um, if you have any questions, you can always send me a message. But I want to see your charts. Um, uh, Whenever you're looking at the market, let me know what you see, and then we can talk about it, or maybe there's points that I can bring up. But for now, you just want to start implementing time frame alignment. So right now we're on the intermediate time frame, and this is the daily chart. We built a market profile using the structure that we can see. And before we actually make any entries, we have to move to the lower time frame, and we'll actually start to discuss that next. Moving from the intermediate time frame onto the lower time frame would be basically just jumping another level down or going down to the next tier. So in the example we've been following, our higher time frame was the monthly chart, where we marked some key levels such as the candle range high and the candle range low, and then we have the equilibrium or the middle point, and that came from our higher time frame. And then on the intermediate time frame, we mapped out a simple market profile, we which helped us determine a bit of structure to help us make decisions. Now, in the lower time frame, is we would use that to actually determine entries. So whether we wanted to enter because it's outside of this range, let's say we enter a short position saying, "Hey, I bet it's going to go down," and then maybe we could exit when it falls back inside the range. Of course, it went outside the range here at this point, so we would have lost one trade at least. Maybe we could have done it again up here. We would have won this trade if we just went short saying, "Hey, I bet it's going to go down." And even if we just bet it was going to go back into the range from the top to here, still a good bet. Now, what we would do here is up in the air. There's a lot of factors to determine. Just because it went down a couple of times outside the range, back into the range, doesn't mean it's going to do that again. But uh, just to keep it simple, right now, we're going to take a look at the lower time frame, moving from the daily chart to the lower time frame. In this case, would mean we just go to the 4 hour time frame. So we use the monthly for the higher time frame, daily for the intermediate, and then 4 hour for the lower time frame. There are again other combinations for different types of trades. In this case, we're looking at swing trading, which is kind of just taking trades maybe a few times a year, maybe like once a month, possibly. So the time frame we're working with is a bit larger. As you can tell, just what we see on the screen here is from Thursday, October 2024 to the moment, which is January 2025. So it's a lot of time in between. So there's a bit more thought that goes into these trades because you have to determine when a good point is. For example, in December, in the middle of December, if you bet that it was going to go outside, or if you bet that the price was going to go down, there might have been a couple of good bets here you could have made. So we're not trying to catch the entire length from top all the way down to the bottom, but maybe at a few points based off of the lower time frame that we're looking at. You can see this line was the CRH or the candle range high that we marked. You can start to see we were trading outside the range at some point. We did touch outside the range, so maybe that would have been a good bet. We can see that uh, we start to get a better idea of what kind of trade we want to make. Now we'll go further into detail on like entry models and how to actually decide when to enter a trade, whether you want to go long, which means to bet that it's going to go up, or if you want to go short, which means to bet that it's going to go down. We'll go over those strategies a bit more in detail in the future or in later chapters, but for now, I just want you to understand how to align the time frames using the higher time frame along with the intermediate time frame and then the lower time frame. As we discussed, we just demonstrated how to use it. So just start practicing that. Make sure you review the video. Maybe you don't get it the first time and you have to watch it multiple times. I know when I first started, I went over the same topics several times to get a hold of it. But now the entries, although I'm not going to go into specifics on how to pick a great entry because there's a lot to consider that we still have yet to go over. But if you were looking at it right now, let's say we were trading outside of the range, and you see that most of the time when we trade outside of the range, we're going to go down. So you want to manage risk, right? You don't want to just take the risk of an infinite loss. So when using TradingView, if you go here to this section, you can see long position, short position. These are just tools to kind of like map out a trade. So like we said before, that short position is betting that it's going to go down. So we open up the short position and we click, and we can choose what our limit is on the top side. So in this case, the limit I want is this right here. And then let's say I entered right now, so we move it to where the price is at. And then my goal is down below here. Let's say I think we're gonna break below, because look, hey, every time we touched above, we made a new low. We touched above, we made a new low. So maybe our game plan is this. Maybe we're saying, hey, we have a new high. We went outside the range. We went outside the range, and we're also outside the range. And then what we're saying is that we noticed, one second, is that we noticed every time that happened, we went down. Let's make a color. Okay. So every time that happened, we went down. Every time that happened, we went down. So let's say that's our game plan, right? So right here would have probably been very risky if we would have done that here, because you see the distance, and let's say we're going for the bottom, we would have hit it, but it would have been a 1.57 risk, meaning that if this was going to cost us $10, we would have only made five. So there's a little bit of math when it comes to risk to reward ratio. Maybe I'll go over that. If you need me to go over that in specific detail, we can go over that, or I can make a separate video. But it's easy to visualize when you look here. You can see if we lose, we know how much we're willing to lose if we plan ahead of time. So you would just have to work out the size of your position, which we can discuss further whenever we're talking about actually trading. But for right now, we're just looking at using the lower time frame to uh, come up with trade setups or potential trade setups using the fundamentals that we're going over. And then once we get over the fundamentals, we'll go over more advanced topics. So just moving forward, uh, just to kind of map it out a little further for you so you can see how we would frame these trades. So basically, the idea, at least right now, that we're looking at on the lower time frame, after doing the top-down analysis, we say we're trading outside the range, and we can see that when we did that last time after making the new high, let's say we want to notate a bit just to kind of keep an eye on things. Let's say we want to be real specific. Where's it at? Oh, I'm missing it. What am I looking for, sir? I they call out the okay. So let's say we know we made a new high, so that's important to us. Okay, so we can say we broke through the range, we made a new high, and the price went below back into the range, and then we can see that we traded outside range. outside of range. And then it dropped again, right? And then we traded outside the range again. So we entered this position here, okay? And then we put our stop loss here, meaning that if it went back, we would cut our losses here. But our target was below these lows. Of course, you can make it lower depending on how much you want to risk for the reward. See, this is real small. This doesn't make sense here. But let's say we go for this low because that's what our strategy was based off of. We would barely make it, but we make it. If we waited, we'd make it. There's a couple chances where we would have been able to take profit. But let's say we were smart and we took it the first time. We're good to go. But look how much we had to risk. So maybe our overall reward is going to be lower. So maybe instead of risking 10, we only risk 1. Here, we can see we have the same setup. We're outside of the range. Price went down. It did break the low, so maybe our strategy is still valid. We wait for us to trade above the range. And we see that it's closing low a bit right here, so maybe we enter here and we put our stop loss at this recent high. Now you can see the risk to reward might be a bit more appealing. That doesn't necessarily mean it's going to go, because what happened in the past doesn't mean it's going to happen again, but we have a solid strategy starting to form here. And we can see how we notate things. Mark out the key levels and we start working our way down to come up with a game plan. So let's say if we were to enter here, we would just set it and forget it. We would enter a short position and set our stop loss. We would set our stop loss to here. And this can all be done and set up so that way the orders are already placed and you don't have to really think about it. And I wouldn't recommend that you do that. So if you do all this work to come up with this plan and you're confident and you know how much you're willing to risk, if it goes past this point, that's already all written, basically. So you enter, and then if it hits your stop loss, you lost. You're on to the next one. Rome wasn't built in a day, but it burned in one. So you have to be careful. If you get greedy or if you keep trying to make back what you lost, you can get caught up in a situation where maybe you're wrong entirely and price just keeps going up, but you keep betting. Or maybe you keep doubling down and you're just wrong. So we define our risk, we frame our trade, so we know what we're willing to lose if we're wrong, because we could always be wrong. And then we know what we stand to gain. But at the end of the day, once we uh, build the model and we execute, we have to just let time unfold. So that's how you use the lower time frame to model an entry. All right, so moving away from the charts or trading view, um, we want to just kind of cover what the process that we went through. Excuse me. First, we looked at the higher time frame, which in our example was the monthly chart, and then we marked the key levels. We identified a candle range, and then we used the ITF or the intermediate time frame to determine a basic market structure and build a profile. Uh, and then we moved on to the lower time frame to frame an entry setup. Um, uh, One thing to note is our method of uh, identifying the trade that we did in our work through uh, was a bit crude. So that's not an exact trading model that we would be using with the strategies I'm going to teach you. It's just based off of what's going on in the market right now and something to look at or it was processed to take you through so that way you can see how we think basically when we're forming a trade. Uh, we start with the higher time frame, we move to the intermediate time frame, and then we actually build an entry setup or a trade setup in the lower time frame after we've gathered the information we need to form a bias so that way we can know are we going to go long or are we going to go short. Now, the process will stay the same uh, regardless of the type of trade you're taking. It's HTF, ITF, and then LTF. But depending on the type of trade, it's going to determine what intervals you actually use. So we went through swing trading, or we went through a swing trading model. So that's when the monthly chart is used for key levels and candle ranges, and the daily chart is used for structure. And profiling and entries are on the H4. If we were to do short-term trading, we would still have the same framework, which is the HTF, ITF, and LTF, except we would swap out the intervals that we use based on the strategy. So if we move to short-term trading, then we would be doing weekly key levels and candle ranges. We would be doing structure or market structure. We would look at the H4 for the ITF, and then the H1 would be the LTF for profiling and entries. If we look at the intraday model, which is a model where you're not intending to hold trades for longer than a day. Usually, the intention is to close a position within 24 hours. If we're doing an intraday model, then our higher time frame is daily or H4. So we'll go into specifics later on in the mentorship when we start building on with more advanced concepts. But for now, just know intraday trading. The higher time frame is typically the daily or the H4, which is used for key levels and candle ranges. H1 is used for basic market structure, and the a 15-minute chart is used for market profiling and entries. Now, when it comes to scalping, typically that's more higher risk method, or the margins are a bit lower. But scalping is a very quick trading. So the idea is trading trades that are held anywhere from a couple minutes to a couple hours, but uh, definitely less than a day, and typically no more than a few hours. That's what scalping is. If you were scalping, your higher time frame would be 15 minutes. So you can see uh, for swing trading, the higher time frame is a monthly key level. When it comes to scalping, the higher time frame is only the 15-minute chart. And then you use the 15-minute chart for key levels, and to identify counter ranges. And then the intermediate time frame is the 5-minute chart. And then profiling and entries are done with the M1. Now, a very important thing to mention is that regardless of the model that you're using, the approach is top down, or the best approach is top down. So even though you're scalping and using the M15 as your key levels, you'd still want to keep in mind higher time frames. Of course, keeping an eye on the monthly, uh, weekly, and daily um, is a good way to stay oriented and make sure that you're not taking trades that are overly ambitious or unrealistic. The idea is to take advantage of larger moves by positioning yourself where you can take the low hanging fruit. Um, 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 Not that you're missing out on larger moves, but the whole point is to aim for practical targets. Uh, Everything shouldn't depend on one trade, or the outcome of one trade shouldn't uh, affect your performance overall, because we're talking about being net positive over time. Um, and It takes a bit of skill, but with the strategies I'm sharing with you, uh, if you study and if you're engaged, I'm sure you should be able to figure it out. I'm here to help too, as well.